Started investing in mobile home parks in 2014. Did about a year of due diligence trying to find the first one, but bought the first one and assembled a portfolio of 2,300 pads. Sold that portfolio around COVID because at that time the pricing got a little weird. So I took a pause on putting money to work when peak pricing got a little nutty. After the correction in 2022, started putting money back to work because we once again started seeing more reasonable pricing out there. And so this is the team at Vintage Capital, the leadership team. We have a talented group of people in the back office that help with investor relations and accounting, of course. But this is the leadership team. We're going to jump back to just kind of the starting point. So 10 years and 100 million in mobile home parks. Is the thesis still compelling, right? The initial thesis that got me into this space 10 plus years ago touched on that, but does that still make sense today? Is that still the same today? All right, so mobile home parks, as we kind of talked about with Ramez, we're not talking about trailer parks here. It's a spectrum. We're talking about affordable, clean, valuable housing. Some of these look like subdivisions, right? This one in particular, this was a recent investment that we made in 2024 with our joint venture partner. This is in Montana. This looks like a subdivision when you drive through it. The only way you can even tell that it's a mobile home park is there's really skirting on some of the homes, and you could tell the home is a little raised. But other than that, rolled curbs, some of the homes even have garages. So why listen to us? I've been in the industry a while. I've kind of shared my background, but thankfully we've also done very well. So we've invested in over 4,000 pads, average gross return of 23%. There's the experience in terms of 12 years and 100 plus million track record in money put to work. And so to answer the question of the intro slide, I think the thesis does still hold. And why is that? 57% of Americans live paycheck to paycheck. As you know, most or half of the country has a hard time dealing with a very large surprise bill that pops out. Maybe their car breaks down, or they have a health issue, a medical bill that really strains the household. And then on top of that, the median retirement savings for a senior is only around 175K. And of course, this is the median. So that's the middle, right? So there are a ton of people, right? Hundreds of millions that have less than that. So if you think about it from the standpoint of people living longer and having to stretch that retirement, and then on top of that, Social Security, that is not looking, that program, while wonderful, it certainly has been questioned whether or not we can continue to have Social Security last as long as people think it's going to last, because the government keeps taking from that capital account, that money each year, right? So we have a retirement problem in this country, and it's going to get worse before it gets better, right? So then why does one mobile home park, and a mobile home in particular for a retiree, why does it help solve that problem? And why is it valuable and still interesting as an investment? Well, we talked about it being affordable. The initial vision of this industry was that it wasn't a trailer park. It was a nice community for retirees, 55 plus, where you could sell your stick-built home, you could take that nest egg, and then you could go buy a much cheaper and smaller, more manageable mobile home. That was the initial vision of the industry, and that's what we tend to focus on. We tend to focus on turning these properties that might have been owned by mom and pop over 30 years. There are a lot of deferred maintenance, right? We focus on coming in, injecting capital, and improving the appearance of the park, hopefully upgrading the home stock over time, and then really delivering that value equation to the end client, the mobile home owner. Because it is an extremely valuable asset that we're giving them. We are giving them the alternative to buying a very expensive stick-built home. If they want to downgrade, in size, they can, and in their monthly payment, They can take that money and then go buy a mobile home outright. The cost of a new mobile home is around $120,000 on average. And that's, some of those are double wides and some of those are, single wides that are going to be more in the $80,000 range. Then there's the extreme affordability in the $50,000 range. But this is the average of all the new mobile homes sold last year. And the monthly all-in cost of that home would be about $854. Whereas a stick-built home today, a new stick-built home is going to be $500,000 plus, right? And so your upfront cost when you're buying a new home is that 20% to get that mortgage. Of course, that's $100,000, and that's almost the cost to buy the entire mobile home, brand new mobile home outright. So you can see how this is valuable for a lot of Americans.
Somebody's asking, Brad, do you guys focus mainly on new builds or rehabs?
We focus mostly on parks that are existing. I have done development in the past. I think that it's just a lot easier to go out there and find an existing park. There's about 50,000 of them nationwide. There's probably about 10,000 of those that we would entertain owning. Whereas there's only a handful of new developments a year, which is part of the thesis that we're going to get into. Number one here is a declining supply. So if you think about it, there's only a handful of new projects across the entire country that are approved every year because there's NIMBYism, right? Not in my backyard. There's this misperception that we've talked about where people think it's going to be one thing, but instead of this beautiful, nice new mobile home park that looks like a subdivision. So they're hard to get approved. They take up a lot of space, whereas some of these towns would rather have a retail center come in because the tax dollars to the town are going to be higher. So you have declining supply actually because some of these parks are demolished every year for higher and better uses. So there's more being demolished than there are being built in any given year. Then you couple that with number two here, huge tailwind for demand. As you can imagine, as we talked about, there's an affordable housing crisis. It's hard to imagine that getting better anytime soon, especially when we're about 4 million homes shy on stick-built homes, right? So we have a ton of need for affordable housing in this country. So a giant demand of tailwind demand, and which leads me to three, that ends up creating this dynamic where this asset class does extremely well in recessionary environments. Because once again, when you're at that cross section of declining supply and increasing demand, that's a pretty good pricing place to be. So we don't jack the rents up, but we can increase the rents over time very reliably. And we don't have giant spikes in vacancy because once again, this is the last affordable stop on the housing train, right? So there's next to us, right? They're not going to get anything of this quality for anything cheaper. They can maybe go to a Class C apartment building in a rough part of town, but that certainly is not comparable from a product standpoint to what we're offering, where they can drive up in their own driveway. They have nobody on all sides, right? Like an apartment, you have somebody above and on each side and sometimes below. And here, you have your contained unit, you can have your own yard. And so families tend to prefer this asset type over Class C apartments. And then this fourth point here is these are capital light compounding machines, because once you come in, you buy this asset and you improve it, you inject some capital to maybe redo the roads, maybe clean up some of the homes, the common areas, add some amenities. Once you do that initial capital push, there's not a lot else that goes wrong, right? Land doesn't have too much maintenance on a year-to-year basis. And so you, as the park owner, you own the infrastructure, you own the roads, the driveways, right? The pipes, and you're offering that to the tenants that own the actual mobile homes themselves. And so they take care of the toilets, right? And the kitchen appliances that sometimes stop working, right? So they have to upkeep those, and we don't get into that game too much. And so we get to just get the benefits of that reliable cash flow because we're not constantly having to put more capital just to maintain the asset after usually that initial push. Here's just some data which we won't go too deep into, on the declining supply, but it just compares manufactured housing versus some other asset classes, which always see new supply in just about every year. Recession resistant. This shows the sensitivity in net operating income compared to a 1% change in GDP. So as GDP declines, right, hotels obviously take a huge hit because they're tied to business travel, they're tied to disposable income, or to mobile home parks, which in a recessionary environment, because once again, the demand is inelastic. The demand is a constant for affordable housing. You're always going to be paying your rent and needing someplace to live, even in a recession. This is a lot of numbers, but just take a quick look at the highlighted mobile home park line here. The row shows how NOI, net operating income growth has transpired over the last two downturns, right? So we had the 2008 recession, the credit crisis, and we had COVID here. And as you can see, still positive numbers in those very difficult time periods for real estate. Just about every other asset class saw negative NOI growth, right? The peak being lodging, hotels in 2009 here, down 34%, whereas mobile home parks up 5% roughly. And so this up and to the right growth of net operating income is what makes, I think, this investment so compelling for a retirement long-term investment, is because it's kind of something that you just put to bed, right? Through good times and bad, people continue to pay the rent. The occupancy tends to stay very stable. It's counter-cyclical, so it diversifies against some of your other investments that are more tied to the health of the economy, right? For example, if you have, industrial hotels, that kind of real estate, and you have the S&P 500, well, those two asset classes are fairly correlated to each other. The health of the economy is going to be a major driver of the outcome in both of those investments. Whereas when you add something like mobile home parks, you're actually making your portfolio more robust because you're adding returns that are not correlated to the broader stock market and the broader economy. And then this point on compounding machines, the fact that we're not having to throw capital at the parks every year. Once we do our first push on the capital improvement when we come and buy a new property. On the right here, one of the drivers is tenant turnover. So with apartment buildings, the rent roll is always churning, whereas with mobile home parks, the homes don't go anywhere, right? Sometimes you might have a tenant that decides to leave the park, but what they'll end up doing is they sell their home to a family member, a friend, who then ends up paying the lot rent the next month. The home itself does not move. It's only 2% of the turnover, the rent roll of a mobile home park is churning every year relative to most other asset classes that see much higher turnover year in, year out. And of course, when you have turnover, you have renovation costs. You have to turn those units. You have to usually paint carpet, right, for apartments, maybe replace some appliances. Maybe you want to redo the kitchen to try to spike rents. We don't have that same dynamic in manufactured housing, because once again, the tenant owns the home, we own the infrastructure, and it's very expensive to move these homes. So they don't just go back and forth between properties. And then as a capital expenses as a percent of revenue, we've kind of touched on this, but here's just actual math from Green Street about apartments and student housing and self-storage all have a higher percentage of capital expenses every year as a percentage of revenue relative to mobile home parks because of everything we've talked about. Okay. Well, I wanted to go over this slide. Yeah, I'm going to have to go into this screen for this slide. So this touches on this concept of why manufactured housing is great for retirement accounts or for just holding long term. And that's because if you think about it, when you have an opportunity to make an investment into something that you think you can hold for a very long time, that's what we want in the investment world. That to me is what we're constantly shooting for. We don't want to try to buy and sell and flip things every 3 years, because that becomes more of an operating business. That becomes difficult to time. You're constantly having to make new investment decisions. You're getting a lot of transaction cost drag, right? By going in and out of new deals. You have to pay the taxes when you sell things. So if you can buy something and hold it for the long term, that is how you let compounding do its thing and do its magic. And this graph really drives that home. Now, the quote here talks about, hey, investors will do better with a 14% return held in an open-ended fund over 15 years than they would in a 20% fund that you turn 3 times. So in other words, 20% type of investments. Every 5 years, you're going in, you're going out, right? So you have tax costs, you have downtime to make the next investment, to put the next money to work, and you have the friction costs of these transactions. And so you get lumpier cash flows, as you can see with this black line relative to the pinkish line here in an open-ended fund, where you just let the money compound, right? And so, yes, the sponsor might be taking their profits every 5 years or so in terms of a promote, but you're not having to pay the taxes. You're not having to redeploy the capital if you're going in and going out. So something that you can hold long term at any kind of teen type of return is extremely compelling, and that is what we tend to shoot for. Most of our investments are targeted around 7 to 10 years, but we do make exceptions when we refinance a deal, right? We get our capital back and we have no more risk in the deal. I hope we hold that thing indefinitely. I hope we are giving those properties to my grandkids someday, because we're benefiting from this cash flow. We're benefiting from the tremendous tax benefits in this space, which we'll touch on next. And we're letting that cash flow continue to compound by having that money stay at work, as opposed to coming in and out of the market and trying to time things and doing all these investment buying and selling that ends up impacting returns, as you can see here on the graph. All right, so this is a nice little summary slide, but sorry, go ahead.
I was just say the screen just froze for a split second, but I think you're good. Unless
okay,
you're good, you're fine. That's fine.
So on this slide, I just want to really touch on the tax benefits. The interesting part about this space is that when you think about a mobile home park, you think about, okay, well, if you own the land and then they own the homes, then, well, it's a land investment. And so what could you actually depreciate? What tax benefits could there be? Because you can't depreciate land. Well, the reality is that in most of the markets that we're buying into, the park isn't located, in downtown, right? So the land value itself is not a giant component of the purchase price. It tends to be anywhere from 20 to 40%, depending on the market. And so that leaves a lot of value in the land. We talked about the roads, the driveways, the pipes.
Brad,
I
didn't mean to. Brad, I'm so sorry. I didn't mean to cut you off. Is there any way that we could get it back in presenters mode? I wasn't sure if I was the only one that could see it, but we have a couple IRA Club clients that are asking, can you there you go. Thank you so much.
Yep.
Thank you.
Yeah. So land improvements are 15-year property, and anything that is 15-year property, you can accelerate to year 1. So now bonus depreciation is less impactful for your IRA investments, of course, but just want to touch on these tax benefits in case you are entertaining this outside of a retirement account as well. So when you bonus depreciate things, right, you can often get dollar for dollar benefits. In other words, you invest $100,000, you often can get $100,000 of losses that first year. Now, it depends on the cost segregation study. It depends on your CPA. We're not a tax expert. Talk to your accountant. But oftentimes that is the case, especially after the tax law just changed a couple months ago. where we now have 100% bonus depreciation again. So this is a unique, compelling feature that further benefits people that can hold long term, because if you hold long term, you don't have that depreciation recapture, and so there's giant after tax benefits. It often will boost the IRR, after tax IRR, right? If you can think about taking that tax benefit and offsetting other capital gains taxes, it often will boost the IRR 500 basis points, so 5%, right? Which is extremely compelling benefit as well. This is just a quick case study. We're not going to go too deep in the weeds, but this is the Montana park that we invested in last year. This is a larger park. This is about almost 300 pads, 99% occupied. It has been about that occupancy for 20 years. If you just look at historical aerial shots of this park, you can actually look at Google Earth and see back 20 years that, hey, this thing has been full for a very long time. Most of the park was redeveloped in 1999. So effectively in our world, that's like a new park, because most of the properties, as you can imagine, were developed in the 70s and 80s. The cash on cash for this one was 4% going in, but 9% by year 7. So we tend to not focus on the going in cap rate, because this park, for example, has been in the family for an extreme time, and they just didn't have a huge incentive to dial in the operations in order to maximize cash flow growth. And so now it has new professional management with property management systems, right? Expense control, looking at the utilities, making sure those are dialed. And you can do things at the margin to get that cash flow up. And so once again, this is one of these investments that I hope we hold indefinitely. We'll likely refinance this in 4 years. We went in at sub 50% leverage. That feels extremely good from a risk standpoint. It's hard to go bankrupt without pushing leverage above 50% with an individual asset. And then from the debt side, this is Fannie Mae loan. So Fannie Mae is the largest lender in the manufactured housing space. They love this asset class because of the risk return dynamics that we talked about in the beginning. And so, yeah, we're very excited about this one. And this is currently in our fund, which we will be closing at the end of the year. This is also in our fund. This is an investment we made in Charleston. So this is a little bit more on the affordable side of the equation. This one does not look like a subdivision, right? But this is a pretty solid park as well from an infrastructure standpoint in a great market, right? We love this area of the country from a demand standpoint. A lot of new migration coming into this part of our country, and we like to see investments in the Southeast, because we feel like besides having the great demand, there's a lot of new investment from companies, from manufacturing plants are all moving their buildings down there because of the tremendous tax benefits that have just been released with new factory development via the new tax program. So there's a lot of great things going on in this area of the country, and we're excited to have this one. Similar cash flow profile, right? Where we try to get to kind of 7% cash flow within 3 years. And then that's generally when we start thinking about refinance. If you remember from our track record, about half of the deals that we put to work, prior to 2024 have been refinanced already. We love that profile, right? You make the investment, you do the improvements, then you go back and do a refinance with Fannie or Freddie. You pull out the cash flow, right? And you continue to benefit from the ownership and the growing dividends while not having any risk in the investment. That's the dream scenario. It's what we always shoot for. No, we actually do allow investors to pick and choose individual deals. So we will offer up both the individual sleeve and then the fund. I tend to think the fund is better for most retail investors, right? I think we saw a problem with apartment buildings where people would make one investment in one apartment building, and that could have any number of things go wrong with it. Whereas you only want to really do that if you're making like 10 of those investments, right? So I always think it kind of depends on your liquidity and how much money you can put to work. But I tend to think that funds are better if you can only write one check or maybe two, right? Versus diversifying.
Got it. So Tony just popped this in. He said, disregard my question. I thought we were just, investing in the asset. So the answer is no, we're doing the fund. Somebody asks, what is the minimum investment?
The minimum investment for the fund is 50,000. And yeah, for individual investments, we have done 50,000 as well. It kind of just depends on how much money we are raising for an individual asset. But the fund is certainly more flexible because it's getting diversified over, it's going to be 15 plus properties by the time it's done. I think we have 11 as of now.
11 as of now. So somebody asked, I think this pertains to one of your slides earlier, about who's covering these items: insurance, permits, utilities such as water, sewer, etc. That's obviously not going to be the investor.
No. So yeah, each individual property has its own LLC, right? The investors are a limited partner in any property that we're investing in. So their risk is only the amount of money that they are putting into the investment, right? There's no risk at the tenants, want you to pay something, right? No, right? So it stops at the fund. But yeah, the utilities for the most part are reimbursed by the tenants. Either sometimes they're billed directly by the individual utilities of that city.
Got it. Got it. Hank, what's up? Long time no see. Are you sorry, is this a difference or differentiating between mobile home parks and manufactured home communities? Is there a difference?
No. See, the industry really is fought hard to try to make that new rebranding to manufactured home communities, right? And so, but it's a mobile home park, right? It's like the industry, the people want to call it a mobile home park, so we call them mobile home parks. Now, if you want to think about it in terms of the nicer quality mobile home parks, yes, I kind of think of those as manufactured housing communities. And for the most part, those are the ones we are trying to focus on, right? It's a spectrum. Sometimes we buy out of 5 stars, right? That's the scale. A 1 is a trailer park, a 5 is an extremely nice retirement community. We're kind of playing in the middle to upper, right, range of that scale.
Follow-up question from T, which is this open to accredited investors only? I think, did you answer that already?
No, I did not. Yeah, as of now, it is. In the future, we might have opportunities for non-accredited. So hopefully this will still educational, but yeah, for now it is accredited.
Okay, just always keep in mind, I know some of the people that are joining us are non-accredited, okay? It doesn't matter. The goal is one day to get there, right? It doesn't matter. And by the way, I hate that rule that's applied, accredited versus non-accredited. I think that some of you that are non-accredited are more savvy than others that are accredited. I hate to say that out loud. It's kind of a funny concept, but the focus is to always think what's available, educate yourself on what's out there. That's why I host these webinars. And then this is you're not only entitled to use your retirement dollars, you can use your personal dollars. There was a question in the chat that popped up. I don't have 50,000. Can I partner? Brad, actually, I'm just going to ask you this question. If somebody doesn't have a full 50,000 aside their IRA, 401k, or HSA, can they use 25,000 from their IRA and let's say 25,000 from their personal dollars, partner together to invest in your fund? Or let's say a husband and wife can partner together.
Yeah, a husband and wife for sure. The other question I'm going to have to leave to my investor relations contact.
Got it. No problem.
I don't deal with the back of the house, unfortunately, so I'm not sure if we can do that. But yeah, certainly if a couple wants to put their funds together, that's fine.
Got it. Well, Alex, I will make sure that to show you where to find out where that deal is. Oh, if the fund that's not available, or is the fund available to a 1031 exchange?
It is not. We have done 1031 exchanges for somebody that has, $1 million check plus in terms of their exchange. We have been able to make that work for individual deals, but it doesn't work for a fund because it's like kind property. So you have to do sell a building, you got to go buy a piece of property. You can't invest in a syndicated portfolio of properties.
Got it. Okay, somebody asks, do I need to be accredited even when I'm investing from my IRA? I'm assuming the answer is always going to be yes.
Yes. Yes.
Question.
Yeah, I do think there will be some news next year from the SEC that is loosening the requirements for accredited. I mean, fingers crossed. Like
Yep.
I am a big believer in giving access to private investments to people's retirement portfolios if they are knowledgeable. So hopefully there's a test and we do change that requirement. But yeah, for now it is.
D asks, can you please show the 12th of 24 returns on the fund again? Are the payments paid quarterly or monthly? And what is the length of time for the dollars that are invested in the fund?
We actually pay monthly distributions, which I think a large subset of our investors like, because it starts to feel like a paycheck replacement as they continue to grow their passive income. The underwriting is 14 to 17% for the fund over 7 to 10 years. We have achieved that in the past. Our average, net IRR has been 19% across all the mobile home park investments that we've invested in my track record. So yeah, we think the opportunity still exists to hit those returns. We're very optimistic. We love the portfolio that we've already assembled. We've got, like I said, I think it's 11, could be 10 deals in the portfolio right now, and we should get to 15 by year end.
Okay, a couple of people back to the accredited versus non-accredited. Here's my 2 cents to everybody that's listening that is non-accredited. Highly recommend that you reach out to vintagecapital, right, .com. Get on their list, all right? So for example, if they do happen to have in the future, let's say a 506B, as long as you're within that database of theirs, they can reach back out to you as a non-accredited investors. As a non-accredited investor, Brad, I may be jumping the gun when I'm talking freely about your own funds, but I'm always telling people to communicate and network with each other at the end of the day. So that could be a possibility, Brad. Wink, wink. I'm just talking out loud. Is that possible in the future?
Maybe, we'll see. I mean, I think it's great to educate, right? There's a lot of resources on our website. I've mentored a ton of people that have gotten into this space over the years that I continue to invest with as a limited partner. I'm all about improving the space. And I do think, the more people know about it, the more they're going to like, and hopefully someday that they're at that threshold or the restrictions get a little bit easier.
Okay, question asks, Justin, is this all POH, which stands for park-owned homes? If not, does the park have its own HOA rules that apply to the residents?
So the first answer to that question is no. Most of the parks that we're investing in are largely tenant-owned homes, right? Okay. Where the tenant owns the home, we own the infrastructure of the land. There are some park-owned homes in the portfolio for sure, but it's a minority percentage. And the Southeast has some higher use of park-owned homes than most of the country. But the second question about HOA, there's not technically an HOA. What there are is park rules, right? So you sign a lease, you get a rule set that says, hey, look, you got to keep your lots clean. You have to make sure the house is presentable, yada, 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 right? So there's certainly rules that need to be enforced, but there's not an HOA per se, where there's a board with cookies and lemonade at monthly meetings where people are having opinions and fighting each other over basketball hoops that shouldn't be on their home.
Nice. Good to know. I didn't even know that, by the way, Brad. You just taught me something new. Thank you for all of this great information.
Thanks.
Take care, guys. Always a pleasure.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.